Hey, what's up, family? Welcome to another Food and Finance Fridays on Lyle's Legacy. Today, I want to take a sweet dive into the IUL, okay? And I'm going to break down Index Universal Life Insurance, all right? And so, speaking about sweet, sometimes I want to eat something sweet, just a little sweet snack. And, since I've been on this vegan journey, there's two things that I've come across that are like, oh, really good. All right, so usually, I have some cooked food, but today I'm just boom. Like, what is that? Here I have a medjool date. Took a bite of it already, and I have Turkish fig. All right, and speaking about the figs, something kind of funny that I remember in Matthew chapter 21, the Bible, Jesus was going about and he was hungry, he was walking, he saw a fig tree, walked up to it, about to get looking to get a fig from it. There were no figs, although it had leaves, you know, but it didn't have any figs, so he cursed it, right? And I'm like, what is the big deal about figs? All right. So I had never experienced a fig outside of a fig Newton. All right. But I'm like, okay, let me check it out. All right. And I had saw it one day, just last year, actually toward the end of 2023, and I saw for the first time I actually saw a fig. Like I said, I never experienced it out of outside of a fig Newton. But I'm like, okay, let me check this thing out. So, but the medjool date, you know, these I have been knowing about these for a while. I had used them in different recipes, and mm, it's really good, really sweet. Tastes like candy. It's just really good. Here with the Turkish fig, was good, really sweet. Reminds me something of a jelly donut. It's just really good. It's a perfect snack. Whether you're trying to be live a vegan lifestyle and you want a sweet treat, or you just want a nice healthy sweet treat. You're not trying to be a vegan. Then these two right here, winners, winners, for real. Mm, really good, and you don't have to have a whole bunch. Grab yourself a couple figs, grab yourself a couple dates. It's a little filling, tide you over for a little bit. Okay, so but getting back to the IUL, so what's so sweet about it? First of all, like I said, what the IUL stands for is Indexed Universal Life, and again, it is insurance. Okay, I kind of ran out of room, but we'll see. All right. So that's what we're dealing with. My ring light's trying to steal the show. Okay, so that's what IUL stands for. It's Index Universal Life Insurance. Okay. What is insurance? Okay. And so you hear about insurance. You have auto insurance, homeowners insurance. People have insurance on their phones. Okay. So, well, what does insurance actually mean? Well, insurance is the transference of risk. Okay? So take example, like I said, auto insurance, right? So the insurance company is saying, okay, you're out there driving. It is possible that you could get in a car accident, either with another vehicle. Um, '05, I had a near fatal car accident with a tree. All right, so not always a car. A deer might jump in front of you. You know, here in Ohio, Northeast Ohio, we have a lot of deer. Okay, so that's something can happen. That can happen. The insurance company is saying something like that happens. You know, we're gonna take care of you. You pay your deductible. You know, when an incident happens, and you know, we'll pay for the damages to be repaired if they can be repaired. Sometimes a vehicle has to be totaled out. At the end of 2022, my wife was involved in a car accident where she was rear-ended. She had traffic stopped and she had to come to a quick stop, kind of go over to the shoulder. A vehicle behind her rammed right into her. Okay, her vehicle was totaled. You know, she had an SUV, and that person's insurance company, praise God, they had insurance. They paid out. You know, Mari had to go through the whole process and everything, but paid out to where we're able to go get her another SUV. Had to add a few $1,000s to it, but it was the insurance company gave us a whole lot more than what we had to contribute, right? How they able to do it? Well, you know, they have each person that has a policy pay a premium, which is just a monthly payment. Okay, the premium is the monthly payment. Now, of course, the car insurance, you know, it renews every 6 months, so it could be paid in full for 6 months, or you could do the monthly. All right, so it's the same thing with life insurance. Okay, what is the risk that's being transferred to the life insurance company? It's the risk of death. Okay, they call it life insurance, but it's for when you die. The most basic definition. Okay, so the insurance company is saying, okay, so you're gonna die. You're gonna at some point you're gonna die. All right. So in that case, you pay your premium. You continue to pay your premium. If when you die, we're gonna pay out whatever the death benefit is. You know, whether it's, you know, 5, 10, 15, 20,000, 50,000, 100,000, 250, 500, a million. You know, if you're loaded, you know, you're really rich, you know, and you get $1 billion life insurance policy, right? Of course, you're gonna have much bigger premiums. You paying, you have that type of death benefit. Okay, we're gonna pay it out. And once again, how are they able to do it? Because there's a bunch of people who own a policy with this company, so they're able to, you know, use that money and their investments, you know, from the premiums, boom, and they pay you out, right? Okay, so what kind of life insurance is there? There's two major types, okay, two basic types. There's term, and there is permanent, okay? There's term and there's permanent. Those are the two basic types of life insurance. Okay, so term is for if you die. Okay. If you die within those terms, the term can be 5, 10, 15, 20, 30, with some companies up to 40 years, okay? Now, if you, their life insurance company says, if you die within this period of time, we're gonna pay you this money, right? But what if you don't die within that time? Okay, and what if you are too old to renew? You too too sick or something, where you're not even qualified. Uh, that is the risk you take. Okay? There's places for term insurance, though. I'm not saying at all that term insurance is bad. Okay? There's a place for it. Permanent insurance is for when you die. Okay? It's for when you die because it's permanent. It's for your whole life. Okay? So we have that. So we have what insurance is. We have what does IUL stand for? Again, that's Index Universal Life. Life insurance. What is insurance? It's the transference of risk. And there are two main basic types of life insurance: is term and it's permanent. Okay. Now I said a sweet dive into IUL, right? So what's sweet about it? Well, let's look at it. For one, it's permanent. Okay, you're gonna have it all your life. All right. So IUL is permanent. Okay, so all permanent insurance is permanent. So what's so sweet about it? Let's get into it. Okay. So there are benefits. Benefits to the IUL. Okay. So one, you have a death benefit. I just put in DB for a death benefit. But is it just for when you die? It's not. It's what you call, they have living benefits. All right? Some people are like, oh, okay, so I'm going to have this life insurance. So, when I die, take care of my family. That's a good thing to do. All right? Some people even use it to donate. All right, there are scholarships that have been left behind because of life insurance. Okay, of course, main thing, you want to take care of your family. You have a family, take care of your family. Okay, what if you're much older and you don't have young, or you're single and you don't have young people to take care of, that to support. Is there still a place for it? Yeah. Okay. Everybody needs life insurance. Okay. For one, we're gonna die, so you don't have to raise a GoFundMe. You have life insurance that take care of you and bury you. Okay. That's not sexy, but you need it. You can leave your family. Let's say you're older. You can leave your family a tax-free inheritance. All right? Tax-free. That's something else that's sweet. Okay? But what about like I said, the living benefits? Can you enjoy it when you're alive? Yes. So let me switch those. Put tax-free up here. Put the LB down here. We'll talk about it. So let's say you get a diagnosis and the doctor says you have less than a year to live. That's called terminal illness. Man. All right, yeah, so I have this life insurance for when I die, so my family be taken care of. But there's some treatments that's needed that could keep me alive. right? And that my health insurance won't take care of this certain treatment. Well, you can have a living benefit of a terminal illness rider, right? Where the insurance company will pay you a portion of the death benefit to go towards treatments that can maybe keep you alive or at least make it so that your maybe your death isn't as painful. Okay, or now it's for treatment. That's what triggers it. But maybe you want to enjoy the time you have left with your family. Like, hey, I'm tired. I'm not gonna fight this anymore. Okay, I've been through this before, or maybe you just want to enjoy the time. You don't want it. You just the thought of constantly being in the hospital, them poking and prodding you, whatever. Hey, let's take this money. Let's go on vacation and enjoy the time that we have left. Maybe you want to use it to pay off debt, or you can use it for whatever you want. Okay, so what if you have a diagnosis that's not terminal illness? They don't tell you that, oh, you are going to die in less than a year. And of course, let me say this: just because they say they give you less than a year to live doesn't mean that's necessarily going to happen. What if you do get better? Okay, do you have to pay that money back? No, you don't have to pay that back. But what if you get diagnosis of cancer, or you have a stroke or something, to where it's not gonna kill you? Maybe you have a stage 1 cancer. They caught it. They can do treatment to take care of it. To do an operation so they can get rid of it. All right. So that takes money, right? And when you get all those treatments, maybe you're not gonna be able to work, are you? Not while you're getting the treatments, and maybe you're on the job and you're out of the PTO, paid time off, or maybe you're a business owner and you don't have that health insurance that would take care of that. Well, that's called critical illness, right? All right. So that it can help. Once again, you'll get portion of the death benefit advanced to you. Where you can help. You can pay for bills. You can pay for treatment, whatever you need, right? What if you don't get an illness like that or anything? What if you get an illness that's chronic? You're going to be dealing with this for a while, or you get injured in a way, you get sick or injured in a way where you're not able to complete 2 out of 6 activities of daily living, or called ADLs. What is that? That can either be considered chronic illness, where you can have a chronic illness rider, okay, where it acts like long-term care. You can also have a long-term care insurance on there, where you're going to need assistance to complete something like walking or toileting, or dressing, something like that, or eating. Okay, you need significant assistance for this stuff. That triggers an event, that chronic illness or a long-term care event, where again you have a portion of the death benefit advanced to you, so you can take care of the stuff. Now, okay, I'm gonna get a little bit personal. My father in 2013 was diagnosed with dementia. All right. Um, that was something. It was a scary blow, to see my father, who I looked at as Superman. Okay, I looked at my father as Superman now, and he's already well advanced in age in his 70s. And so, but I still, man, this is still one of the strongest men I know. He was diagnosed with dementia, which is a brain disease, is degenerative, and it start to lose your memory. Your body starts to fail after a while. It's a slow process, and it's hard on the family. There are times he didn't know who I was. He thought I was one of his brothers. You know, that he grew up with. But then it came a point where he had no memory of me. And so my mother, at one point, she had to hire, aides to come in and help. All right. I didn't know about this stuff. When that happened, it was after that he got diagnosed, that I became knowledgeable of the stuff, that I got into the financial services industry, and started to educate myself and educate others. And I learned about this, and I became angry. Ooh, I was so mad that we didn't know about the stuff that we could have had in place to help pay for the AIDS and the different treatments. So my mother ended up paying for that stuff out of pocket, thousands and thousands of dollars a month. Where this is something that we could have had. Is we already had life insurance, right? But there's no living benefit. It's something a very small additional fee. And some insurance companies actually have it built in where it's not an extra fee, but that it could have taken care of this, because that money that my parents had saved, they didn't intend for it to go to something like that. Praise God, they had it, to help. But that's not what they intended it for. So what if they had something like this, where it could have been paying for the additional help that was needed, and they could have used, the money they had saved for what it was intended for. For me, that right there, to me, is priceless. Okay, so I need to go on that tangent for just a little bit, because it's something seriously to think about, But I want to talk a little bit about how it works, okay? So talked about it's sweet, that of course, like, that is permanent. We talked about some of the benefits that it had to it. The benefit, of course, the death benefit, living benefits, right? But something that all permanent insurance has is cash value. All right? Cash value. Cash value, what you mean? It has the value of cash that's building in your policy. Okay? Now, depending on the type of permanent insurance you have, it's going to grow differently. All right? Here, things you have. It's the same thing like in other markets, okay? You have your fixed growth, okay? Where it's dependable. You know what it's going to do. All right? You have a guaranteed rate at which the money's going to grow. You can count on But when you look at that, it's not very exciting, is it? You know. Another way you can grow is in a variable. It's another way your money can grow. Kind of like a roller coaster. It can be exciting, but really, do you want your money doing that, right? Okay? Do you want to have heart palpitations looking at your money going up and down? All right. But then we get to what the IUL is. Okay. Take it a little bit extra. Okay. So you see, right here is looking pretty similar to the variable, right? But you see these dotted lines? That's what the index is doing. So this is the market, right? It's going up and down, up and down. Now, when your money is in an index account, it's not in the market, but it mirrors the market, okay? So as the market's going up, you see the cash value is going up. Nice, right? But what's this here? It's going down, but that line didn't go down. That line became level because it has what's called, I was going to try to write upside down and backwards. That wasn't going to work. It has something called a floor, okay? What that floor means is that when the market goes down, just like the floor that's under my feet, that it keeps your money from going down, okay? So the market starts doing this, bam! You know, you hit that floor, and what's sweet about it, you notice that each time the market goes down, you get a new it hits the floor and it goes back up, you get a new floor. So it just keeps climbing. And then when the market goes down, it levels off. Okay, so we have that. That's the sweet thing about it. Okay, oh, baby. Okay, baby. Go in the bathroom, I'll be right there, okay? Oh, baby. So I gotta be quick about this. Gotta go be there for my baby. All right. Okay, so and that's the beautiful thing that it does, right? So in the IUL, you have two buckets, okay? Two buckets. In one bucket, you have the life insurance, okay? This is gonna take care of, from when you die, but it also has attached to it the living benefits that I talked about. Sweet, right? Okay, so you have, let me do it like this. You have your premium. You have your premium. A little bit of your premium is going over here to take care of the life insurance, living benefits, all that stuff, right? But over here, you have the cash value. This is a much bigger chunk that's going over here, and it's in the indexed account. That's not neat at all. I'm sorry, y'all. Let me write that again. I need it to be legible. All right, so thank you, mommy is helping my baby. So I'm gonna stick to this. Okay, so it's going in that index account, and that index account that has the growth, participates in it mirrors the growth on the market, but it has the floor so that you don't lose your money due to market volatility. Okay, so these are some of the things that's pretty sweet. Okay. So you have the living benefits, life insurance living benefits, the cash value that's growing in the index account, and then, all right, so it's growing. Let me put this down here before I bust myself in the head. Okay, it's growing, but what about when you get access to that money? What happens when you want to get access to that money, right? So you have money in your bank, it's taxed, right? Taking money out of, let's say, your 401k. You're going to be taxed. And if you are below the age of 59 and a half, you also will get hit with a 10% penalty. All right? What about stocks, bonds, annuities, taxed? Stuff that's in, well, I already said 401k, that's the deferred account. So that you're going to be taxed on that. But this here, you take your money out via a loan, it is tax free. See that right there? Tax free. That's pretty sweet. Got stuff falling, but that's okay. All right? So it's going to be tax free. And so, listen, when I tell you that the IUL, Index Universal Life Insurance, is a sweet deal, it really, really is. All right, so are there any drawbacks about it? Yeah, it's a long play, okay? It's not that quick turnaround. It's something that you have to be dedicated to it. That it's like, listen, I know this is a long play, but there are some strategies that can be used to where it really bolsters the effectiveness of this policy, because the thing is, the policy it's just a policy, it's a tool, but you have to use that tool correctly in order for it to give you the maximum benefit. All right, so I hope that this was helpful. If you like the video, go ahead, hit that like button. Don't forget to subscribe, share, so other people can be blessed with this information. It helps the channel grow. Go ahead and leave a comment. Let me know what you think. If you have any questions, you can put it in there. You can also contact me via email at loudslegacy22@gmail.com, or give me a call, 330-319-0141. Both of those will be in the description if you want to learn more about it. Also, hit the notification bell so you'll be notified anytime I upload a new video. Yeah, this is something. One of the things, you need to have a financial professional to talk to you about it, to walk you through it, to help you get it set up. You definitely want to get with someone that you trust. Like I said, if you have questions, give me a call, email me. I'll definitely be sure to get back with you. I'm here to serve. All right. So, folks, hey, again, I hope this was helpful. Be blessed. I'm out.